Good morning, everyone. Thank you very much for inviting me to the Bharat Inclusion Summit organized by IIMA Ventures. I couldn't have turned down this invitation even if I wanted to, primarily because it comes from the premier management institute in the country, but also because as a central banker, we never turn down any request from BIS. The BIS I'm referring to is the Bank for International Settlement, who is the central banker of central bankers. But the Bharat Inclusion Summit, by having the same initials, put added responsibility on me. In whatever format, can't say no to BIS. I particularly would like to thank Professor Abhiman Das, Ms. Priyanka Chopra, and Dr. Pawan Bakshi. And it's great to be addressing startups, fintech entrepreneurs, the cutting edge of the global status that India has today. That ecosystem, you all form a part of that ecosystem. As central bankers, we understood the importance of technology in everything that we do, whether it is for monetary policy transmission or for financial inclusion or regulation, supervision, anything. We understood the impact of technology, and Reserve Bank has been working over the last 2 or 3 decades on ensuring that absorption of technology is achieved optimally. I won't go into the background of all that we have done in terms of setting up institutions, in terms of in terms of transforming the payment systems and so on. But one aspect I would like to stress at the beginning is that we always realized the role that the fintech ecosystem plays in the objectives that RBI has, in the goals that RBI has. Especially over the last 10 years, especially in the payment space, but spreading over to lending and other spaces in the financial system as well. Initially, there was a sort of gap. The fintech ecosystem wasn't really interacting as much as Reserve Bank would have liked them to do. We took the initiative. Personally, myself, governors, and the various fintech officials, fintech department officials in the Reserve Bank, made additional efforts to make sure that this conversation between the ecosystem and the regulator stroke developer, which Reserve Bank is healthy, constant, and productive. Especially over the last 1 year or so, we have started these forums for interaction on a regular basis with the fintech community. We call them the Finteract, the Finquiry, the FinConnect. And all those have helped substantially, helped us in understanding how the ecosystem works, what the expectations of the ecosystem are, how should regulations be tuned to the requirements of this ecosystem. At the same time, I would like to believe that it has helped the fintech ecosystem to understand the expectations of the regulator, understand regulations, understand the importance of trust, which would come from responsible innovation. Fintech community at the initiative of RBI has come up with an SRO, more are likely to follow, to further formalize such interactions. So as a part of those interactions, it's a pleasure to be addressing you. What I will do is briefly talk about the environment for financial inclusion, some of the key initiatives the Reserve Bank has taken over the last few decades, in fact, and what are some of the challenges that we face. But after that, I will shift over to how technology, and particularly digital public infrastructure, can play a catalyzing role in achieving financial inclusion. Now, all of you know that financial inclusion is a key driver of socio-economic growth and poverty alleviation the world over. An inclusive financial system supports stability and promotes equitable growth. 8 out of the 17 United Nations Sustainable Development Goals of 2030 view financial inclusion as a key enabler by improving the quality of lives of the poor and marginalized sections of the society. Financial inclusion has been defined as the process of ensuring access to financial services, timely and adequate credit for vulnerable groups such as weaker sections and low-income groups at an affordable cost. The objective is to provide convenient access to a basket of basic formal financial products and services: savings, remittance, credit, insurance, and pension products to low-income households and small businesses, using technology as a key enabler to cut costs and improve delivery. Broadly, financial inclusion revolves around 3 key dimensions: access, usage, and quality. I would briefly mention each of these points. First, access. Some of the key regulatory interventions include the Self-Help Group Bank Linkage Program. Started in 1992 as a pilot program, this has blossomed into the world's largest microfinance program with 144.22 lakh SHGs, with saving linked with banks, having 65,000 crore balance outstanding as at the end of March 2024. Credit facility has been availed of by approximately 54% of SHGs, with 77.42 lakh credit-linked SHGs, which is about 79% of these are under the National Rural Livelihood Mission. And the total amount of credit outstanding as at the end of March 25 is 2,59,000 crores. The second is the basic savings bank deposit account. Started in 2005 as a no-frills deposit account. The name subsequently shifted to basic savings banks deposit accounts. This was one of the key underpinnings of financial inclusion in the country. The launch of the Pradhan Mantri Jan Dhan Yojana in 2014 boosted access to bank accounts. During the last decade, the number of accounts has increased significantly from 39.81 crores to 70.59 crores in 2024. Balance in the account has also increased from 0.43 lakh crores, that's trillion, 1.43 trillion rupees to about 3 trillion rupees during this period. The third key initiative that Reserve Bank had taken was the business correspondent model. In 2006, RBI permitted banks to use the services of BCs for providing banking and other financial services. BCs have emerged as a critical enabler in propelling the cause of financial inclusion, especially in the rural hinterlands, with the same being corroborated by the exponential growth in volume on a CAGR basis of 25% and value 35%, rooted through this BC channel. Now I'll come to usage. The most important initiative in this regard was the priority sector lending program. In order to channelize credit to the underserved and unserved segments of the society, these PSL guidelines were formalized in 1972, and lending targets were first advised to banks in 1974. Over the years, the focus of these guidelines have sharpened towards disadvantaged sections of the population, with the sub-target for lending to small and marginal farmers and to weaker sections, both raised in 2022 by 2 percentage points to 10% and 12% respectively of adjusted net bank credit. Credit flow to micro enterprises is channelized through a specific sub-target of 7.5%. Now all these sub-targets ensure that the credit needs of the smaller borrowers do not get crowded out. The National Strategy for Financial Inclusion 2019-24 was put in place to help expand and sustain financial inclusion across the country through a multi-stakeholder approach. Significant headway has been made on both the supply side and the demand side of financial inclusion. Banking services have been provided in more than 99.9% of the targeted villages within a 5-kilometer radius or hamlets with 500 households in hilly areas. On the demand side, the National Center for Financial Education has developed relevant modules in the form of audiovisual content, booklets for target groups like farmers, MSMEs, SHGs, students, etc. And now I'll come to the quality. While recognizing that one-size-fits-all approach does not yield optimal results, targeted financial literacy content has been prepared, which, among other things, includes focused messages for MSMEs, SHGs, and so on. These are used by stakeholders involved in the efforts to spread financial literacy, such as banks and NGOs. The importance of women-focused approach is recognized in the financial literacy process. RBI has stipulated that lead banks of every district should set up financial literacy centers. These centers are required to conduct periodic financial literacy camps for specific target groups. An innovative way to impart financial education through community approach for reaching the last mile has been the setting up of centers for financial literacy projects at the block level. As of March 31, 2024, a total of 2,414 CFL projects were operationalized across the country. These CFLs conduct financial literacy awareness camps for the age groups of 18 to 60, and women are a key target group. On consumer protection, the integrated ombudsman scheme of the Reserve Bank is in place to provide an alternate, cost-free redressal system for customer complaints involving deficiency in services rendered by entities regulated by the Reserve Bank, if not resolved to the satisfaction of the customers or not replied within a period of 30 days by any regulated entity. Regulated entities have also been advised to institute internal ombudsman mechanisms, and their performance on this front is also being monitored. What are some of the challenges in the spread of financial inclusion? Firstly, in order to measure the extent of financial inclusion in the country, a comprehensive financial inclusion index has been developed by the Reserve Bank with elements of banking, insurance, and pension. The index comprises 3 sub-indices: access, usage, and quality. The March 2024 value stands as 64.2 of this index. Over the years, there has been considerable progress made under the access sub-index. However, there is scope for further improvement under the usage and quality sub-indices, while also addressing gaps under access. For instance, gaps persist in credit delivery, such as those to MSMEs, especially those owned by women, small and marginal farmers, and SHGs. These gaps will have to be addressed effectively. A smartphone in itself does not necessarily translate into preference for digital transactions. Complex interfaces, risks of misuse of documents, digital documents, language barriers, and concerns regarding breach of OTP PIN constrain their usage. Hence, improving and simplifying complex interfaces of digital channels and addressing language barriers in digital transactions through use of vernacular languages would be helpful. Inactive BCs hamper quality of delivery, especially in rural areas. The BC ecosystem needs strengthening, such as through the BC certification program, to ensure that the quality of services offered at the last mile is at par with bank branches, something that is being monitored by Indian Banks Association. Rural women customers are more comfortable transacting with women agents. However, at present, female BCs constitute approximately 13% of total BCs in the ecosystem. Increasing the share of female agents need to be accorded due priority. And I'm sure, looking at the panel that just preceded us, where 75% of the participants were women, we are probably on our way to improve these statistics. I will now shift over to the use of technology to address financial inclusion. The key strategy that Reserve Bank has adopted for absorption of technology is through what can be called digital public infrastructures. A key feature of digital public infrastructures is the universalization of access through interoperability. While the public sector develops DPIs, fintechs are provided and encouraged access to innovate and add value addition stacks to these infrastructures. DPIs are designed for scalability and customization, unlike traditional approaches that address specific problems in silos. Prominent examples of such an approach, for example, are Aadhaar and Unified Payments Interface, UPI. DPIs help in lowering transaction costs, fostering competition, interoperability, and enhancing individual choices. Over the last decade, the payment landscape in the country has been revolutionized, transforming customer behavior and expanding the reach of payment services and economic activity, thereby fostering financial inclusion. India, a leader in development of state-of-the-art payment infrastructure, is also a front runner in global digital payments innovations. The core theme of RBI's Payment Vision 2025 is e-payments for everyone, everywhere, every time, which aims to provide every user with safe, secure, fast, convenient, and affordable access to payment options. Through its various initiatives for developing India's digital payments ecosystem, RBI has positioned financial inclusion as a central theme in its regulatory approach. Underscored by a move towards less cash society, India's digital payments journey has witnessed many firsts: interoperable QRs, two-factor authentication, Aadhaar-enabled payment systems, and, of course, UPI. The UPI, a flagship product launched in 2016 by NPCI, an entity set up by the Reserve Bank, has emerged as the most preferred mode of payment, with 59 crore transactions every day. That's roughly 80% or a little higher of total digital transactions. 59 crore transactions every day, amounting to 80,000 crores in value. The intensity of digital payment usage has shot up multifold. The number of transactions per lakh of GDP increased from 0.8 in 2005-06 to 56 in 2023-24. Small businesses in particular have found QR code-based UPI payments to be a cost-effective and efficient business enabler. In addition to UPI, other key digital payment products include trade receivable account discounting systems, which facilitate financing of trade receivables of MSMEs from corporate buyers, and Aadhaar-based payment systems, which allows for basic banking transactions through the BC model using Aadhaar authentication, extending financial access to remote and underserved areas. During 24-25, 61.31 crore transactions worth 3 lakh crores were carried out through AEPS. RBI also operates a Payment Infrastructure Development Fund, PIDF, which subsidizes deployment of payment acceptance infrastructure such as POS devices, QR codes, in Tier 3 to Tier 6 centers. Northeastern states, Union Territories of Jammu and Kashmir and Ladakh, and also beneficiaries of PM Swanidhi scheme and PM Vishwakarma scheme in Tier 1 and Tier 2 cities as well. Nearly 4.22 crore devices have been deployed under PIDF since 2021, of which nearly 53% were deployed in Tier 5 and 6 centers. To capture the extent of digitization of payments across the country, RBI has also been publishing another index, the Digital Payments Index, since January 2021, with March 2018 as base. The RBI Digital Payment Index has seen remarkable growth and is at 465.33 in September 2024. In India, one of the most significant impacts of digital payments has been in the implementation of direct benefit transfers, or DBTs. The number of transfers, as well as the total amount transferred under DBTs, have witnessed a significant rise in recent years and have grown at a CAGR of about 14% by volume and 31% by value in the last 10 years. During 24-25, 686 crore DBT payments were made for a value of 6.6 trillion rupees. 83% of all DBT transactions are processed via the Aadhaar-based APB mode, Aadhaar Payments Bridge mode. DBT transactions span central schemes like LPG subsidy, MNREGA, PM Kishan, pensions, maternity benefits, as well as state government welfare programs. DBTs and other governance reforms have led to an estimated savings of rupees 3.49 trillion until March 2023. I will come to now, just before I close, the key DPIs in the fintech space other than UPI. Now, RBI, as I said right in the beginning, has always been leveraging technology and innovation to address gaps in collaboration with the fintech's ecosystem, gaps in traditional banking and other financial services. There were about 13,600 fintechs as of December 2024. India ranks third in terms of number of fintechs after US and UK. And this evolution is underscored by India's remarkable fintech adoption rate of 87%, surpassing the global average of 64%. Fintech platforms have expanded credit access to individuals and small businesses lacking a formal credit history. A recent survey by FACE, a fintech SRO, showed that their fintech members had disbursed loans to underserved populations, including new to credit individuals and typical subprime borrowers. In financial year 2024, personal loan penetration grew by 24% in Bihar, 21% in Tamil Nadu, and 20% in Uttar Pradesh compared to the previous year. Fintech lenders are facilitating small ticket size credit products with 41% of loans being less than rupees 25,000. RBI encourages innovation, apart from encouraging fintechs, through a regulatory sandbox, which has run 5 cohorts in themes as varied as retail payments, cross-border payments, MSME lending, prevention and mitigation of financial frauds, etc. Having received 123 applications over the year and tested 36 solutions under the scheme, under the sandbox scheme, with 20 successful exits, out of which 15 are already deployed in the market. RBI also conducts an annual global hackathon called the Harbinger. There have been 3 editions of the hackathon so far with themes such as smarter digital payments, inclusive digital services, zero financial frauds, and being Divyang friendly. RBI has also set up the Reserve Bank Innovation Hub in this city, Bengaluru, and it has been key in bridging the requirements between the Reserve Bank of India as the regulator and the fintech ecosystem. It has also developed some digital public infrastructures which can transform finance in the space of lending. One such is the Unified Lending Interface, ULI. This is designed to enhance credit accessibility and efficiency using alternate data sources that obviates the need for cumbersome one-to-one integration of lenders with multiple data providers. Simply speaking, ULI is a platform that has lenders on one side, banks and NBFCs, and the data that is required for these lenders to process loans on the other side. At present, more than 60 such data sources have been linked to this platform. This platform commenced, it's currently on a pilot stage, it commenced in August 2023. As of April 2025, over 14 lakh loans amounting to 65,000 crores, including a substantial number of KCC, that's Kisan Credit Card loans, and MSME loans, have been dispersed using APIs from the platform. 44 lenders, including various banks and NBFCs, are utilizing these 60 data services, more than 60 data services, thereby facilitating, at this point in time, 12 loan journeys. Just to give you a flavor of the benefit that it can do, let me go back to the first loan journey that ULI tested, which is the KCC loans given to small farmers. This process normally took about a month, if not longer, involved multiple visits by the farmer to a bank before the lending is processed and the farmer receives the loan. Accessing through ULI, either on their own or in an assisted mode, through any electronic device, computers, cell phones, anything, you can actually complete this journey in less than 15 minutes, beginning to end. So the potential for revolution in lending space of this system is limitless. In fact, ULI has much higher potential as more and more databases are getting linked, including Aadhaar, GST, land records, crop patterns, satellite data, everything. As more and more of those things get linked, while the platform itself does not store any data, the platform can actually enable, even account aggregators are linked to it, can actually play a key digital public infrastructure role in terms of data authentication and data access in general. The second digital public infrastructure, which is being tried out now, is the Mule Hunter by the Reserve Bank Innovation Hub. The idea of the Mule Hunter is to have an AI-driven engine that can be trained on the database of the entire lenders' systems, banks, NBFCs, and identify mule accounts. It has been tried out in about 3 banks now, and the success rate is actually more than 90%. Now, while many networks and many providers have their own systems of identifying mules, this, since it works as a digital public infrastructure and therefore has access to the data across the banking system, this is likely to evolve as probably the enabler to deal with financial frauds. Another initiative that the Reserve Bank had announced and is taking is creating a digital intelligence platform whose idea is to look at transactions as they happen and assign a risk score to those transactions to enable the lenders, banks or others, to take a call on whether to approve these transactions or not. This also will be driven by AI/ML engines. This also will use data not just from lenders, but across the system, such as telecom operators and others. These two systems in particular, once they develop and are fully implemented, will probably play a transforming role in enhancing trust and confidence in digital systems, digital financial systems. I will close by talking a little bit about the inclusion potential of CBDCs. We all know what they are. The pilots have been going on for a while. Maybe some of you also have CBDC wallets. It's currently undergoing many iterations, both in terms of technology and issue models and so on, so that gradually, based on experience, we improve its efficiency and uses. One particular area where the efficiency of digital payment systems and inclusion hasn't really worked is in global payments, global retail payments. Even today, these payments take anything up to a week, with the cost going up to maybe about 6% for retail small value transactions. Given the fact that the current model for global payments, as it goes through the banking systems and has multiple hubs, the potential to reduce costs there, even with the digitization, is limited. What can actually fill that gap and create that efficiencies are CBDCs. Because they are currency, and currency is settled as soon as it is handed over, without the need for an intermediary. And because they are digital, so they transcend barriers of space and time, you can actually imagine a future when money can be transferred at a fraction of the cost from a person or business in India to a person and business anywhere else in the world, almost instantaneously. Globally, there have been a lot of efforts in achieving efficiency in the payment systems for global transfers. We are not seeing much traction there yet, but we believe that CBDCs will be the game changers there. So that is a space that I would request all of you to watch closely and carefully. There are certain aspects of CBDCs which are, again, digital money, just like bank deposits, but more credit because issued by central banks or governments. There are certain benefits of CBDCs that clearly score over other electronic money like bank deposits that you hear about, or any other private wallets or deposits. Now, this gives them the potential to redraw the map of global payment systems. Exciting times ahead for all of us, and I look forward to many more innovations coming from the fintech space. All the very best. Thank you, and thank you for this, all the best for the summit.